problems with unsound money is it modifies the denominator in the sense that you don't understand the value of the transactions, which means that you either live your life from guess to guess, or you live your life dishonestly.
All right, welcome everyone. This is Jim Forsythe of Citizens for Sound Money, and we're privileged to have Rick Rule on with us today. So Rick, welcome and glad you could join us.
Jim, thanks for the invite. I appreciate the opportunity to talk to your audience.
Yeah, and just a upfront disclosure, or maybe it's also a plug, but I got involved with Sprott, actually watching a bunch of your interviews and got interested in the company, and I did the portfolio review. And I wound up talking to Mishka, who is my portfolio manager. That was back in 2019. Been super happy with him and with Sprott. And I am an owner of some shares of Sprott Inc. So I'll just disclose that up front. That's also, I don't know if you're going to do your portfolio review offer, but if you do, I highly advise people to take you up on that offer.
Well, certainly if you'll give me the opportunity, I'll make that offer. And thank you both for the business and for being an owner. I appreciate it.
You're welcome. So to kick it off, so you work for Sprott, obviously, well, very big in Sprott, and then now you have quote unquote retired, although I'm sure you're very active with Sprott as well and doing Role Investment Media. Can you explain a little bit about what you're up to?
Sure. I co-founded one business, which was called Quest Capital, a natural resource lender, and solely founded another business called Global Resource Investments, both of which I sold to Sprott. I stayed on to run those businesses for Sprott for about 10 years, retiring last year. I'm still the largest shareholder of Sprott, and I'm a member of the board of directors of Sprott. I'm retired in the sense that I no longer do anything that doesn't amuse me. And working in a regulated entity, that is being a licensed stockbroker, supervising licensed stockbrokers, all those kinds of things, reporting to FINRA, reporting to the SEC, certainly did not amuse me. So I gave up my securities licenses. Administering large numbers of people didn't amuse me either. So I gave up administrative and managerial roles. I now have one employee and I report to her, which is the way I like it. So I guess what you could say is I've become a very functional adolescent, and hence retirement is fantastic for me.
I think I share that in common with you. I'm not technically retired, but I left the Navy to do what I'm doing now and very much enjoying it. So as you know, our nonprofit is all geared towards encouraging people to use sound money, and then we also want to protect the right to do so. So we're organized as a 501c4. Can you talk about why sound money is so important?
Well, it's actually difficult for me, and I realize it's my problem. It's difficult for me to understand why anybody would need to be told why sound money is important. It seems to me that money is many things. It is a medium of exchange, of course, but as a medium of exchange, it should be a store of value. It should be more than a promise to pay. It should be guaranteed payment. Money is also the way that people express their preferences. If I have a good or service for sale, and I have it priced in a way that doesn't generate utility for you, in other words, if the good or service isn't for sale at a price that is low enough that you feel that the goods or services that you had to sell in exchange for the goods or services that you paid me, in other words, if you didn't feel that you were getting a good deal, you wouldn't do the transaction. And one of the problems with unsound money is it modifies the denominator in the sense that you don't understand the value of the transactions, which means that you either live your life from guess to guess, or you live your life dishonestly. And I think those are subpar outcomes. I think that one of the reasons why the United States despite all its failings, thrived for so many years was the persistence over decades of social trust. And I believe that sound money is a key criterion with regards to social trust. The idea that the medium of exchange was, at least to some degree, a store of value. When, as an example, the US dollar was gold backed, or precious metals backed at least, it had real value. But even for some period of time after it went off of precious metal standards, the ability of the United States government to raise revenue relative to the liabilities of the United States government meant that the taxing power, however odious you might feel that power is, gave the government the ability to maintain the illusion that the medium of exchange represented by the US government was a store of value. With debt to GDP at the levels that they're at today, particularly if you include the net present value of unfunded liabilities, it's pretty clear that the medium of exchange is no longer a store of value, which will, I'm almost certain, over time, erode social trust. Remember, I think it was Franz Pick that said of the United States, there's a lot of ruin left in a country that great. And I believe that to be true. In other words, I believe that the American franchise is so large that it can take some more damage. I just wish that we weren't testing that thesis so well.
Yeah, I agree with you on that. And it's my belief that we may return, the government may return to sound money at some point, but not until things are really bad. And that's why we're trying to encourage people to start using sound money and not wait for the government to do the right thing, because if and when they do that, who knows? You brought up, sound money serving exchange. Another thing that comes in is the time preference for money, right? And the Fed with artificial interest rates totally distorts that picture. How do you see, if people start using gold and silver as money, how do you see, kind of market interest rates or earning a yield on your money come back into the play?
Can we go back to time preference?
Yeah, sure.
I apologize for laughing. The current circumstance that we have is easily, in terms of time preference and interest, the most absurd economic spectacle of my career. Let's look at the logic. In fact, let's look at the arithmetic behind the US 10-year Treasury. The government promises that they will pay you, what, 1.6%, 1.7%? If you give them your money for 10 years. In other words, you forced all consumption in favor of them for 10 years, and they pay you 1.6 or 1.7%. In a currency that they acknowledge is depreciating by 6.5%. That means that the government absolutely promises, solemnly swears, to reduce your wealth, reduce your purchasing power by 5% annually, compounded for 10 years. In other words, you pay the government to forestall savings and have them spend, not forestall savings, I'm sorry, forestall consumption, have them consume for you. And you take the interest rate, you take the interest rate and the credit risk for which you pay them too. This is insane. Yeah. That's as though I decided to buy a car and I called you up and said, I want to buy a car and I want you to not buy a car yourself. I want you to wire me $50,000 and I'm going to drive the car for 10 years. And after 10 years, I'm going to wire you back 25,000. Is that okay? You're going to pay me to consume now. Well, I forced all consumption. I'm going to take the credit risk and I'm guaranteed to lose money. That's what negative real interest rates is.
Right.
And one of the reasons why I always say that I'm no economist is I look at the reality around negative interest rates, and economists talk about them with a perfectly straight face, but they make absolutely no sense to me. My belief is if I take credit risk and I forestall consumption in the face of somebody who's less disciplined than I, that I should get paid.
Yeah, exactly. And so you look at negative interest rates by holding dollars or treasury bonds, and then you look at something like gold, and it's had this correlation over long term of sensitivity to the interest rates, right? But and right now that leans in gold's favor, that even if it doesn't produce a yield, it's better than getting a negative yield. But you know, back in the day before the Fed, you know, you by lending gold, you could earn an interest rate. So do you see that coming back into the market? You know, ability to earn yield, maybe market rate yield off of gold, silver, and how that could affect the correlation with treasury bonds?
Well, right now, if you have a sense of humor and you own physical gold, you can lend it for more than the US 10-year treasury rate. There's an active leasing market in both gold and silver. So it is possible to hold your savings in gold. And if you're willing to take the credit risk,
Right.
That is, lend it to a third party, you can receive better interest than you receive on the US 10-year treasury. My friend Jeff Christian has a very active business advising people who hold silver how to generate a yield on their savings, a hugely successful business. So the first part of your question is that the hypothetical market that you describe exists and it's worth billions and billions and billions of dollars. Then it becomes a credit decision.
Right.
You borrow 1,000 kilos of gold for 5 years and you have to pay back 1,000 kilos of gold. And whatever the agreed upon rent in terms of the time value of money is, you don't have to worry necessarily about the depreciation of value because you're being paid back in kind. You may have to worry if you're the lender, if you aren't denominating your whole life in gold, about the relative value of gold to other asset classes. But you don't have to worry if the deal is that you're to pay back 1,000 kilos. 1,000 kilos is 1,000 kilos. So you don't have to worry too much about that. And that business exists today. I'm sorry, I got on such a rant, I forgot the rest of your question.
Well, like, so that business exists, and we had an interview with Monetary Metals recently that's kind of opened that up to, I'd say, smaller investors, not necessarily small investors, but smaller investors. You know, and then there's systems that can provide a yield. If gold and silver start getting a yield for the average, you know, person holding it as money, how would that affect the relationship, the long-term correlation with treasury bonds, or could it?
I think it'll take a long time. I think the franchise that is the US dollar has been built up over a couple hundred years and has been particularly strong in the 40 years from 1982, the beginning of the Volcker years, when, as a consequence of extraordinarily high nominal interest rates and then high real interest rates, the Fed was able over 40 years to lower the interest rate on the US 10-year treasury from 15.5, 15.6, all the way down to 1. That was certainly an epic bond market because, of course, bond, you know, capital varies inversely with the interest rate. So we had a 40-year bond market and we had a 40-year bull market in the US dollar. Because people's expectations, I think, are set on their experience in the immediate past, and the last 40 years has been very bullish for the dollar, I think there's still an enormous reservoir of goodwill for the dollar. So I suspect that a more open market in gold and a more open transactional market in gold, certainly probably brought about by the advent of a gold crypto, which I think a gold token, which will be with us very quickly, while it will help, won't come anywhere close to dethroning the dollar for a substantial period of time, simply because the franchise around the dollar is so strong. And from my point of view, to the people, to the extent that people want knowingly and freely to denominate their lives in dollars as opposed to gold, I think that's wonderful for them. That just isn't the way I'm interested in living my life.
Mine either. Yeah. Well, and there's a distinction between, you know, currency versus money. You know, the people see the dollar as a strong currency in the sense of you can buy things with it, right? But that doesn't mean you have to save in it. You know, spend in it, but don't save in it.
That's absolutely true. People need to understand that conventional savings products today that are denominated in dollars aren't saving. They're dis-saving. It's important that you understand that the interest yield that you receive on US dollar denominated interest is absolutely positively guaranteed to reduce your purchasing power over time. That's a guarantee. It's the first guarantee in my lifetime that the government has made that I honestly believe they're going to keep.
Yeah. And yeah, and you talk about kind of the recency bias of people. You don't have to stretch that much further back, though, in history. It's just not in people's memory. Is post-World War II with the debt to GDP, the way they the way they dealt with that was to create inflation for a number of years, yield curve control, and basically wipe out the bondholders. And so if people just look a little further back in history, they'd see a better example of what we're headed for.
You know, it's wonderful that you point that out. In the decade of the 70s, which is when I came to be old enough to understand sort of what was happening in economics, I watched the US 10-year Treasury rate over that decade increase from sort of 4-ish at the beginning to 15 at the end. What that means is that the capitalized value of a 30-year Treasury that was bought in 1970 was a third of what it had been. The effects of inflation in fixed income instruments is catastrophic. Somebody, maybe it was Pick, called the long bond a certificate of guaranteed confiscation in hard inflationary times. And hopefully those are lessons that we don't learn in as stark a fashion as we did last time. But we will see. You know, I like to tell audiences like yours that there's two different parts of this conversation. We, which is all of us, and I, which is me. And to the extent that everyone else is being careless and profligate, there's no particular reason that any individual needs to do that. In other words, sometimes solving the we problem is bigger than any of us. And my suspicion is if enough of us solve the I problem, that the we problem would take care of itself. That sounds selfish, and perhaps in a sense it is, but your first obligation is to yourself. And to the extent that everybody takes care of themselves, we don't have a commons problem.
I could not agree with you more. That's actually a good way to talk about what we do is, you know, we're encouraging people to save themselves, you know, then reach out to friends and family and spread the word and get them to save themselves. And I agree that if everybody does that, that really kind of solves the overall bigger problem of, you know, living on a fiat system. So yeah, I love that comment. You mentioned blockchain, and we're definitely big fans of blockchain when it comes to gold and silver. 10 years ago when my campaign manager was talking about Bitcoin, I said, well, that's really, really cool, but you know, pair that with a physical asset and it would be you know, the solution to you know, having sound money be usable these days. So you want to talk a little bit more about that, and if I don't know if you have activities in that area that you are able to talk about.
With the caveat that I'm almost 69 years of age, so the technology around the distributed ledger and the blockchain coming from me will be comical to your younger listeners who are more facile on the subject. Sprott, as an organization, and I as an individual have invested in, I don't know, 6 or 7 technologies or protocols around using the distributed ledger to make gold money. Not knowing which one was going to win, we looked for the ones where we had the best technology partners, the very best partners. The idea being that the current precious metals market is fairly imperfect. As an example, people buying physical gold and silver for their own possession occasionally have to deal with counterfeiting risk, but also have to deal with dealer spreads,
right?
And insurance. The distributed ledger can take away the need for trust or lack of trust, and the distributed ledger can be almost seamless in terms of cost. So the idea that somebody goes to a bullion dealer and buys themselves 20 ounces of silver and pays a 12% markup, and then when they go to sell the silver, depending on the market, pay a 6 or 7% markdown, means that if somebody turned the silver around on a weekend, they'd be down 20%.
Right.
In a transaction on the blockchain, that transaction could easily be accomplished for 25 basis points, leaving most of the 25 basis points left over for the dealer. Everybody comes out ahead. So we're certainly involved in that as an organization. I'm involved in it as an individual. My belief is that there's going to be a lot of scam coins. There is so much abuse and so much idiocy in the distributed ledger, blockchain, and cryptos. And the idea that somebody is going to be able to pair the hype around the NFTs, as an example, with the legitimacy of gold and silver means that there's going to be a proliferation of BS products. I believe that within the next 2 years, probably, a product will evolve that will be an industry standard. We, meaning Sprott, have set the stage for that with our New York Stock Exchange listed physical trusts. We buy in system, good delivery, meaning it has to come out of the London Bullion Market Exchange or out of the New York Merc. It's stored in the Royal Canadian Mint. We have the serial on every bar. We have claim against the person who sold us the bar, and we transact in fractional units, trust units that represent physical ownership. But that's still cumbersome compared to a token. A token that could be fractionalized means that rather than having evidence of physical ownership in a brokerage account, you could tie it to a credit card or a debit card. You could spend it. You could receive interest on it. You could borrow it. And I think that'll come within 2 years. What your listeners need to pay attention to is what are the protocols, who are the sponsors, and what are the guarantees. Forget the narrative. Look at the plumbing. Right. The plumbing is what makes the currency work.
Right. That's great. Oh, yes. So, yeah, just point that out to our audience that, yes, PSLV, PHYS, the Sprott Silver and Gold Physical Trust, in terms of spreads, that is a really good option. You know, physical, like you said, there's big spreads between buy and sell prices, whereas for the Sprott products, you know, you can buy them on discount brokerages, and the spreads are super tight. So that's a good alternative for saving. But you know, it can't be directly tied to a debit card and so forth. So
I might note too, a naked commercial for our product. If you're an American taxpayer and you buy physical gold or silver or the proxies, the ETFs, in most states you are taxed at the collectibles or ordinary income tax rate. In those same states, if you buy and sell the trust, you're taxed at the capital gains rate. And the idea that one hopes to enjoy quantum capital gains in precious metals, if you and I unfortunately are right about the price of other assets, that you would prefer, I think, to give up less of those gains by paying the capital gains rate.
No, that is a good point. And Sprott and yourself obviously are very active in the mining sector as well. So you want to talk a little bit about kind of the role of how gold and silver miners could play in a sound money portfolio. So we're really focused on the monetary aspect, but that's obviously if you believe we're headed towards increased monetary use of gold and silver, then the mining shares are also a play.
I don't want to tell other people how to live their lives necessarily. Right. When I look at my portfolio, gold fulfills an insurance function. Right. Gold has done a wonderful job of holding its value or occasionally increasing very rapidly, at least nominally in price. When people lose confidence in the purchasing power of other savings and investment instruments that are conventionally denominated in fiat currency, particularly in reserve currencies, formerly the pound, now the dollar. So I own gold as a sort of a fail-safe mechanism. I like to maintain a highly liquid balance sheet personally. And despite the fact that I'm losing money on my cash, I actually maintain a fair bit of cash in my account, because having cash will give me the courage and the tools in the event of a liquidity collapse, if we have one, like 2008, so that I can take advantage of that collapse rather than being taken advantage of. I consider bullion to be good cash, albeit volatile when it's measured against fiat. The mining shares are entirely different. The mining shares often outperform the metals prices, both on the way up and on the way down. You deserve the outperformance because you have a whole series of risks. A poorly run mining company is a guarantee of losing money, an ironclad guarantee of losing money. And one shouldn't have to pay too much to be guaranteed to lose money. So it's important to note that the senior mining companies, the senior precious metals companies, are investments. Now, a side note, I've been in this business for almost 50 years, and I have never seen the senior and mid-tier gold companies as cheap relative to the gold price as they are today. I define cheap fairly specifically. I look at the net present value of future cash flows on developed and developable reserves and resources at current commodities prices. I discount it back and I call that the net present value. Measuring the net present value against the enterprise value, which is the market capitalization less debt plus cash, gives me the equation to determine whether I find these shares to be expensive or cheap. And they are, based on that metric, the cheapest that they have been since 1976, which is pretty attractive from my viewpoint. By other measures too, EBIT to enterprise value, they're cheap. I don't use EBIT as a good marker myself because these are finite life assets. And when people do EBIT calculations, they act as though the revenue stream from the EBIT is infinite and they don't discount it enough. That's why I use net present value. But if you use net present value, these instruments are the cheapest that they've been in my career. So I consider bullion to be liquidity and insurance. I consider the better mining shares to be investments. And I consider the junior mining shares, the exploration companies, the small producers, to be speculations. I don't discourage speculation. All the money that I now invest conservatively, I personally made speculating wildly. But it's important that you understand which role each plays in your own portfolio and determine for yourself how much risk and how much time you're prepared to allow your future.
Yeah, and so I've been involved in the mining space since 2007, and it definitely requires some expertise, and I've come to appreciate getting help from Mishka in that area versus doing it myself. I've done much better thanks to that. So I think that's the bulk of what I wanted to ask. Oh, I did have another question one of our board members wanted to ask is, how have you seen kind of the community interest in the precious metal sector and sound money, over the last several years? Have you seen growth and change in demographic?
I've seen huge growth and change in demographic. I think that's partly due to myself. I started getting involved talking to more people in the last 5 years. At the beginning of my career, of course, I tried to spread my net very broadly and spoke at conferences and all of that kind of stuff. In the middle of my career, I began to constrain my contacts because my existing clients demanded so much time, I didn't have time to talk to anybody else. In my waning years with Rural Investment Media, I've decided to cast my wings again. But I remember 7 or 8 years ago at Sprott at the board level, we were earnestly debating amongst ourselves how we would talk to a younger audience and how we would talk to a non-North American audience, not understanding what was happening with social media. We didn't know how to find young people. We didn't know how to find Africans. We didn't know how to find women. We didn't know how to find South Asians. We didn't know how to find people in the former Soviet Union. But beginning 5 years ago, we didn't have to, because these younger people were very technically facile and they found us. Simply by doing interviews like this on platforms like this with people like you, 75,000 people have contacted me in 2 years.
Wow.
And they've contacted me from everywhere. and of all ages. And what I found is, and this isn't the fact that the world changed, this is the fact that an old man got his eyes opened. As an example, if you are talking to a young South Asian audience, Pakistani, Nepali, Bengali, Sri Lankan, Indian, irrespective of sector, caste in India, you are talking to an audience that has already been culturally attuned to precious metals. The acceptance of precious metals among South Asians of all ages, but including young South Asians, has been shaped by thousands of years of experience with government. The idea that somebody in India will store their savings in rupiah to them provokes howls of laughter. They might, if they're very, very, very poor, buy 3 or 4 extra sheets of roofing steel. In other words, they store their wealth in stuff. I wasn't aware of that till I began to talk to them and ask them about their motivations. So I think that there's a sea change of interest. It makes perfect sense that interest in precious metals would have been higher in the 1970s because there was a demonstration of the narrative. An unfortunate part of human nature is that people pay much less attention to arithmetic and much more attention to narrative. And a narrative can be in place and can be understandable, but until price action has been demonstrated by the narrative doesn't prove itself. When, as an example, in 1970, 1971, the price of gold was fixed at $35 an ounce. People thought if it was uncontrolled, it might go to 45. They didn't understand the inflationary pressures that you had described as a consequence of the communal debt that we had acquired in World War II. There was no interest in gold at 50. When gold hit 200, people were fascinated with it, just in time for the Fed to raise interest rates and the price of gold to fall from 200 to 100. All those people who loved the narrative at $200 hated gold when it was half as expensive, back down to 100. And by selling out in disgust, they missed a market that moved from 100 to 800 in 6 short years. They say that the market, and voters, by the way, always get what they want, usually good and hard. And it's unfortunate that narratives are only appealing to people after they've been proven. And by then, much of the upside has been taken out of it by the very price action that to them proved the narrative.
Yeah, and for those of us in this since 2007 and kind of expecting the dollar decline, and then it's been brutal from 2011 till 2016, but it's required understanding and sticking with it.
Well, I would say, of course, I don't know why I care, but I would say it's been wonderful. I have felt for some period of time that as a society, we relied too much on fiat instruments, and 2, we underinvested in basic materials. And although I have enough to get me through life, for whatever reason, I'd like more. And the idea that I could buy more of these asset classes in size, more and more and more cheaply, was attractive to me. Certainly, I didn't like in 2012, 2013, 2014 being called a fool, but it wasn't the first time in my life that I've been called a fool. And knowing, because I'm familiar with cyclicality, that the goat would turn into a winner again, it was fairly easy for me psychologically to get through that period of time. And it certainly will have and has had a positive impact on my balance sheet. It also allowed us to build a business called Sprott. When we went through that bear market that you described in all things material, many of our competitors in financial services, some of which who were very smart and very hardworking, abandoned the space. They went from being pretty good competitors in mining to technology. Many of them couldn't spell technology. Many of them went literally and figuratively into marijuana. What I'm trying to say is it mercifully deprived us of competition. And it allowed us to build a business with now in excess of $20 billion in assets under management, simply because day after day after day after day, we showed up and got better at the same time that our competitors were abdicating. So I'm truly personally grateful for the bear market.
Yeah, it's interesting. You look at your exchange traded products for precious metals versus some of the competition. You guys are 100% resource focused. You're active in the mining sector. If precious metals don't do well, it's hurts the rest of the portfolio, which is not true of some of your competitors. Where,
we watched a lot of our competitors unilaterally disarm. They went into businesses where they were fairly competitive. They went from a business where they were fairly competitive into businesses that they knew nothing about. Which amused me greatly. Some of them did fairly well. Certainly the Canada stocks had their day. Those people are getting punished as opposed to rewarded now, but that's a different story. We did what we understood and what we believed in. And it's worked out extraordinarily well for us.
Well, I think this sector is going to be the place to be. So, and you guys do a fantastic job. Do you want to wrap up with any comments on how people can find you, what you're up to, and make any offers?
I'd actually like to talk about two things, if I might.
Sure.
The first is, of course, which you're familiar with. I like helping people learn to invest in natural resources, and the easiest way to begin a dialogue is to personalize it. Anybody who goes to a website, ruleinvestmentmedia.com, and enters their natural resource portfolio. Please, by the way, no tech stocks, please no crypto, please no pot stocks, just natural resource stocks. I personally will rank them 1 to 10, and I'll comment on individual issues where I think my comments might have some validity. Understand there's almost 3,000 natural resource stocks worldwide. I have opinions on 700, so you may have some stocks in your portfolio where I say no opinion. That's because I have no opinion. Okay, for those who are interested, if in the question line you mention charts, I will include the Barron's Gold Mining Index, which is a 60-year long pictorial graphic of bear markets and bull markets in precious metals equities. Not because I'm a technical analyst, but rather because it's easier to learn by looking. And if you look at the performance of the gold equities index over 60 years, you get a better sense of the volatility and the cyclicality of gold. It makes you a much better investor and speculator. And I will also include a 110-year commodity chart, which demonstrates pictorially just how cheap the stuff of mankind is, physical commodities relative to other asset classes, going back 110 years.
That's great.
One other thing I want to talk about, though, that I think will particularly amuse you and your audience. I'm celebrating retirement by helping my old, literally and figuratively, friend, Frank Trotter, build a new bank. Some of your people may remember Frank as the architect of EverBank, one of the first online banks. Started in 2000, was built up to a $28 billion bank, and then sold to TIAA-CREF. Unique deposit products, as an example, foreign currency CDs, also gold and silver denominated CDs, that type of thing. We're rebuilding the bank. Our principal lending products will be, not surprisingly, gold loans and silver loans, loans to investors who want to own physical gold and silver, which is held in storage facilities like Brinks and Loomis. So one could say that your deposits are, in effect, gold banked or gold backed, which I think is interesting. This is going to be an online bank again. So people who are interested in a bank that is really truly built around sound money principles might, at the same time that they request the portfolio ranking, just say bank. And I will put those people on a list. Understand that this bank is an organization. It doesn't have a charter yet. But when it has a charter, it's going to engage in a group of businesses, a group of activities that I think will really amuse you and really amuse your subscribers, because it goes sort of to the heart of this discussion. Paying above market interest rates, and lending against collateral that we understand.
Yeah, no, absolutely. And when that gets further along, happy to have you or someone else back on to talk about it.
It's something that's absolutely, I'm absolutely committed to this. It's a really compelling project, even for someone of my age. It's more fun you can shake a stick at.
No, absolutely. Yeah. The more we can provide alternatives to the current banking system, the better.
One of the things I've done is sometimes I correspond with people who send me in ranking requests. And I've corresponded with about 1,000 people, asking them simply, how comfortable, how good do you feel about your bank? And that is the thing more than anything else that gave me the courage to start another one. I've been involved in a lot of banks. People say to me, well, Rick, how will you compete with Bank of America as an example? And I'll say, I can't, but they can't compete with me either. There's a market for what they do. And there's a market for what I do. And so I'm frankly really looking forward to that competition.
Well, and for organizations like ours, there's nothing more creepy than being told, well, you're not gonna be able to touch your funds for a couple of weeks. We have some questions for you. It's like, I thought that was our money.
The banks do forget whose money it is. The other thing, since we're on the topic of banks, I'm one of these really, really, really strange guys who, for amusement, looks at banks' balance sheets and income statements. I know that makes me a weird guy, and I'm actually pretty good at it. And when I look at the balance sheets and the income statements and the interplay between the balance sheets and the income statements on the biggest financial institutions in the country, despite the fact that I've been doing it for 50 years, I don't understand them. The idea that one of these big institutions that has $100 trillion of open derivatives contracts on the book, even if they nominally offset between long and short, they only nominally offset if all the counterparties pay. And the idea that you can have $100 trillion worth of derivatives on your books and have equity that's 3 or 4/10% of that, even if these guys are the smartest guys in the world, and I think Jamie Dimon's one of the smartest guys in the world, even if you're that smart, that's not enough equity. Our bank will, as a target, be 10.5% equity to total assets with no derivatives. Or if we did use derivatives, they would simply be to hedge interest rates. In other words, no trading in derivatives, simply as a hedge. When I look at the activities that the big banks engage in, and I'm very impressed with the intelligence and the hard work of the people at these big banks. But when I look at them trying to lend against collateral in 200 industries, I've been challenged for 45 years lending against oil and gas and mining assets, which is what I do. The idea that they can exhibit or profess some expertise in 200 industries strikes me as odd. And the extent to which they believe that they have enough capital to withstand credit shocks with $100 trillion in derivative liabilities outstanding seems to me insane. And the fact too, that they're all doing time spread lending. In other words, they're lending against 5 or 7 year maturities, and they're funding that in the overnight market. They're paying 25 or 35 or 40 basis points to buy securities that are yielding 1.5%. But the maturities have the obligations they're buying have a 5 or 7 year maturity, and they're funding in the overnight market. If the overnight rates go up, or if the overnight market freezes like it did in 2008, that equity cushion goes to equity heaven. And that's not going to happen with my bank.
Well, that 2019 that happened, right? The repo rate spiked up 9%. And that was before COVID, right? So, well, you say it's insane, but after getting bailed out, are we surprised that they're throwing risk management out the window?
No, I suppose not. I suppose not. One wonders, how much bailout is left. I suppose a lot of bail, as long as there's faith, there's the ability to counterfeit. And as long as they can counterfeit, there's the ability to do bailout. I personally would like to get out of the way of all that foolishness.
Yeah.
I realize I can't get out of the way of all of that foolishness because the government, in addition to calling me a citizen, regards me as collateral. But to the extent that I can sidestep as much of that carnage as I can, I will.
All right. Yeah, that we're trying to avoid carnage ourselves. So anyway, really appreciate you taking your time to talk to us today. And definitely recommend people take you up on your offer. I did that several years ago and was happy that I did.
Great. Once again, Rural Investment Media, list your natural resource portfolio. If you care about the bank, say bank.